In the 1920s, fewer than 1% of Americans dared to buy stocks until Charles Mitchell, a charismatic banker, promised that everyone could be rich. He built a financial empire that dwarfed national budgets, fueled by easy credit and mass persuasion. His plan triggered both America's wildest euphoria and its darkest economic collapse. Today, the same risky blueprint is repeating itself. So why do we never see disaster coming until it's too late? A new kind of magic filled American life in the 1920s. Assembly lines poured out Fords and Chevrolets by the millions. Radios crackled in living rooms from Chicago to small-town Kansas, promising a future of comfort and convenience. Electric refrigerators, vacuum cleaners, and washing machines turned daily chores into something out of a science fiction story. Department stores and glossy magazines sold not just products, but the idea that anything was possible for anyone willing to reach for it. Yet, for most families, the stock market was a distant world. In the early 1920s, fewer than 1% of American households owned any stocks at all. Wall Street was the playground of bankers and titans, not shop clerks or factory workers. Ordinary people put their savings in bank accounts, or maybe in government bonds, trusting slow, steady growth over risky bets. The dream of sudden riches belonged to oil barons and railroad kings, not to the average wage earner. But the hunger for more was everywhere. The country's booming factories and swelling cities bred a culture of optimism. Advertising promised that prosperity was just a purchase away. Credit was easy, and installment plans let families buy now and pay later. The line between want and have blurred. For millions, the idea of getting rich quick, of jumping into the rush, became a tantalizing possibility. All that was missing was someone to open the gates to this new financial frontier. Charles Mitchell didn't just dream of a nation of investors. He built the machinery to make it happen. In 1919, he launched National City Company, a securities affiliate designed to sell stocks not just to millionaires, but to anyone with a savings account. By the end of the decade, more than 69 branches in 58 cities had become sales outposts for Wall Street. Tellers and clerks, once trusted with passbooks and deposits, now doubled as salespeople. Their new scripts urged regular customers to move money out of safe savings and government bonds and into the promise of stocks. Posters and magazine ads asked why settle for savings when you can put your money to work. Inside the branches, the atmosphere changed. Employees were no longer rewarded for caution, but for action. The more securities a staff member sold, the bigger their bonus. Some managers handed out weekly rankings, turning investment sales into a competition. Bonuses for top sellers soared, with the largest pools reserved for those who convinced the most depositors to take the leap. For the first time, secretaries and junior clerks were offered loans to buy shares themselves, tying their fortunes directly to the market's rise. Mitchell's network blurred the line between safe banking and high-stakes speculation. The bank's credibility vouched for risky products, and the sales machine kept humming even as warnings from regulators grew louder. The stage was set for ordinary families and the bank's own employees to become deeply exposed to the coming storm. Margin. Lending turned the stock market into a powder keg. By 1929, Americans could buy $100 worth of stock with just $10 or $20 of their own money. The rest came straight from bank and broker loans. As prices rose, it felt like a shortcut to wealth. But the math behind this boom was ruthless. A 10% drop in stock value could wipe out an investor's entire stake, triggering a margin call. That meant scrambling to find more cash or watching the broker sell off holdings at fire sale prices. Each forced sale pushed prices lower, setting off another wave of calls. The fuel for this fire came from every angle. Margin loan balances exploded from about $1.3 billion in 1920 to $8.5 billion at the peak in 1929. At the same time, investment trusts promised even bigger rewards by piling leverage on top of leverage. Some trusts borrowed 2, 3, even 4 times their capital, using money from banks, other trusts, and anyone willing to lend. These structures created a pyramid effect. Small losses at the base led to catastrophic collapses at the top. Most investors never saw the danger. The promise was simple: a small down payment multiplied gains. But with 80% or 90% of each purchase borrowed, even a modest downturn could erase everything. When the market finally turned, the need for cash was immediate and absolute. Brokers didn't wait for explanations. They liquidated positions, no matter how loyal or long-standing the client. The system that had made fortunes overnight was now primed to destroy them just as quickly. Warnings from Washington started to cut through the noise in early 1929. The Federal Reserve, alarmed by runaway speculation, raised its discount rate to 6%, a clear message to banks to rein in the easy money. Yet, on Wall Street, the appetite for risk was undimmed. Broker call loan rates spiked, sometimes hitting 20% overnight. The cost to borrow was supposed to chill the fever, but instead it stoked anxiety. Rumors swirled that the credit party was ending. Into this uncertainty stepped Mitchell. On March 12, 1929, he stunned the financial world with a bold pledge. National City Bank pledged to supply the market with all the liquidity it needed, up to $25 million in margin loans, no matter how high the rates climbed. He said the bank had an obligation that was paramount to any Federal Reserve warning. Newspapers seized on the announcement, splashing headlines that the country's biggest bank was standing firm against the threat of a crash. Within hours, trading volumes shattered records as speculators rushed to buy. The market, teetering on the edge, surged back in a wave of restored confidence. For a moment, it seemed the worst had been averted. Mitchell's promise became a shield, deflecting panic and restoring faith in endless growth. The press called it a masterstroke. Behind the scenes, though, the risks multiplied. Every dollar of new margin credit tightened the spring, winding the system one turn closer to breaking. The illusion of safety held, but only just, as the next shock waited in the wings. The opening bell on October 24, 1929, unleashed chaos. By mid-morning, the ticker tape was hours behind, unable to keep up with the avalanche of sell orders. Trading volumes soared past 12 million shares, 5 times the daily average. Brokers shouted over each other as prices plunged, triggering a torrent of margin calls. Desperate investors scrambled to raise cash, but few could cover their losses. On the floor, rumors spread that National City Bank was exposed, its own shares collapsing. Charles Mitchell rushed to secure a $12 million emergency loan from J.P. Morgan, hoping to prop up his bank's stock and calm the panic. For a brief moment, a coalition of bankers tried to stem the tide by buying blue-chip shares in full view of the crowd. But confidence had already shattered, the stampede for the exits had begun, and the market's freefall could not be contained. Jobless crowds lined up outside shuttered banks, clutching the last scraps of hope as savings vanished overnight. By 1933, 1 in 4 Americans had no work. Families that once dreamed of prosperity now faced eviction, hunger, and the cold reality of soup kitchens. Charles Mitchell, once celebrated as the architect of a new American wealth, resigned in February 1933 under the glare of congressional hearings. The Pecora Commission laid bare the reckless loans and hidden deals that fueled the collapse, exposing how trust in the system had been sold for profit. Today, household debt stands above $17 trillion, and the same cycle of easy credit and soaring risk shadows millions. The pain of 1929 is not just history, it is a warning written in the lives of those left behind and in the numbers rising again. Today, global debt exceeds $300 trillion, 10 times what it was in 1929. As the same patterns of speculation and easy credit resurface, the real risk isn't just financial loss, it's forgetting that unchecked optimism always has a cost, and history never calls ahead before repeating.